Hello, Maverick Traders. This is Rob Reinhold. It is the Trading Room, and we are into monthly options expiration for September. So let's get into it. In this session, we are going to go over the news of the last week. We'll take a look at the broad markets. Then we're going to break it down sector by sector, score everything from a +3 to -3, and then find some of the best trades in each sector.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, let's take a look at what happened last week. First thing we want to talk about is the market basically recovered all of its losses. The first week of September was horrific. It was down 4%. The second week of September was up 4%. So really we haven't gone anywhere from September 1st. The next thing I want to talk about is the bond yield curve has uninverted, or inverts, whatever you want to call it. All right, I want to use this little opportunity to talk about biases that we have. About 2 years ago, the yield curve inverted. And we heard all the stuff on the news saying, oh my gosh, yield curve inversion means a recession. Like almost all the time it's recession. And I heard a lot of my perma-bears, people that are just always negative. Now look, I used to be a perma-bear. I've talked a lot about it. It was very difficult for me to break out of that bias. I started trading in the late 90s and I went through the dot-com bubble, and when it burst, I was very, very difficult to be bullish after that. So I was a perma-bear for a couple years. So if you are one of those perma-bears that were so hawkish and so bearish when the yield curve inverted and said, oh, it's terrible, we just uninverted. So if you are really looking at data, have you become super bullish now? As much bullish as you were bearish when it inverted? My guess is the answer is no. If that is where you are, if you are one of those people that said yield curve inversion, recession all the time, and now it's uninverted and you're not wildly bullish, why? Well, the answer to that question is you have a bias. Now look, I had this bias for years. I specifically worked on this bias for about 3 years to get rid of it because I realized it was doing me no good as a trader. So I want to take this opportunity to really talk about this. We've uninverted. If you don't feel super bullish and you were bearish when the yield curve inverted, you likely have a bias and you need to work on getting rid of that. You can have a bias in your personal life. I don't care. You can be Republican, you can be Democrat in your personal life. I don't care. As a trader, you're a trader. You are simply trying to find the best odds for a trade regardless of your political affiliation, what you think is happening in the economy. You want to be on the right side. So the yield curve is inverted. Look, I don't think it means anything. Just like I thought the last time the yield curve inverted, we didn't get a recession this time. It's one of the few times we didn't get a recession. This week we do have rate cuts coming, and we're going to be talking about that, but it's definitely been moving these markets. As far as inflation goes, we got 2 reports this week. We got the CPI that came out where the core was a little hotter than expected. The market freaked out a little bit at first and then recovered and went up all day long. Then on Thursday, we got a hot PPI as well. I thought this was going to be actually weak, and it was a little hotter than expected. Again, the market freaked out for a little bit, but then totally shrugged it off. This week, we actually shrugged off 2 hotter than expected inflation numbers, and there's still about a 50% chance of a 50 basis point cut next week. The market has basically said that inflation has been tamed. They don't really care anymore. And that's what these numbers tell me, is that hotter than expected numbers 6 months ago would have sunk this market. People don't care. They think that it's a new world out there. All right, let's take a look at the numbers here for the week. If we take a look at last week versus this week, these numbers are virtually the opposite. The Dow fell 3% last week, rose 3% last week or this week. The S&P fell 4% last week, raised the same amount this week. So basically, we erased what we lost. Oil was down 7% the week before, only bounced back 1%. And gold has hit a new all-time high. Gold up 3.2% for the week, telling you that the US dollar is likely going lower, bond yields are likely going lower. That's why gold is doing so well. If we take a look at the S&P chart, we will see that we have shrugged off a lot of this weakness. Again, we had 1 week of weakness after coming up and hitting this resistance area. We pull back, and really it all happened within this range here. So 5,400 to 5,650 is really the range here. And we are now up at the top of that range. As you can see here, we're back to almost putting in new all-time highs. The big question is, first of all, does it happen? Now, this is where, as a younger trader, I heard things like double tops, triple tops. And I thought, oh, these are so cool. Now remember, I had a bearish bias. So a double top was like, oh my gosh, this thing's going to fall apart. And a triple top, I mean, if a double top is bearish, then a triple top has to be more bearish. No, here's what I've learned. The more times a stock or the market tests a support or resistance level, the more likely it is to break out. We are just testing this over and over and over again. At some point, in my opinion, this is going to break out. The question is it this week? With the Fed meeting on tap, we do have a catalyst for energy to come back into the market and push this higher. If we didn't have a catalyst, I would say, hey, you know what? We just went from 5,400 to 5,625. We probably need to take a pause before we break out. I do think the first 3 days are a pause. I think we're going to be trading in the upper end of this range. But I do think with that catalyst, we can absolutely break out higher. The Qs are a whole different ball game here because we were just not very strong. We do have this wedge pattern forming here. So it is definitely not as strong as the S&P and other markets, but again, I only see breakouts in the horizon. Now remember, this is all during the worst 6 weeks historically of the year. September 1st to October 15th is the worst period of the year. It's just not looking like it this year. We'll have to see. I mean, if we fail, if the Fed comes out and kills this market, then you know what? I might have to come on next week and say, hey, you know what? I was wrong. This is going to be another bad 6 weeks period of the year. It's just not looking like it at this point. Here's the heat map, and you can see just a whole bunch of green everywhere. The financial sector, I'm going to be talking about that, really underperformed this week. And maybe it's because of these inverting bond yields, but it's funny because that should actually help banks, and it didn't. We'll take a look at that sector here in just a second. A market outlook, you look, like I said, I'm pretty bullish here. The more times we go up against that all-time high, the more likely it is we break out to the highs. If the FOMC just doesn't screw it up, we should see it happen on Wednesday or Thursday, in my opinion. They could come out and surprise the market, but I don't see that. Look, the market's like, hey, should we do, take a look at these odds here on the Fed rate tool. There's odds of a 55% chance of a 25 basis point cut, a 45% chance of a 50 basis point cut. Does it really matter? So there's basically a 100% chance of a cut. And my guess is that if they do a 50% cut, in the press meeting they say, we're going to temper the cuts going forward. We're going to be a little bit less aggressive. And my guess is if they come out with a 25 basis point cut, in the press release they say, hey, you know what? We're going to add on more cuts after this. This isn't the only one. So basically, whether you get 50 now or 25 now and 50 later, it doesn't really matter. I just don't see the market cutting on this. And one of the things that we do see across the world is these central banks tend to move together. So the Bank of Canada has already cut rates 3 times. The Swiss National Bank has already cut rates twice. The ECB just cut rates by 0.60%. On Thursday, the Bank of England has already cut rates. look, it's going to happen. Rates are definitely going to be coming down from the central banks. The big question is, how does the market react to that? Taking a look at the schedule this week, we do have some retail sales on Tuesday. Retail sales has been one of those reports that haven't really cared about over the last year or two, but I think this is going to start to get a little bit more important. Right now, the big concern is the economy slowing too much? This is a big number when you ask that question. Is the economy slowing too much? As you can see here, the core retail sales are supposed to be solid. The headline number is supposed to be a little bit low. We'll have to wait and see what happens on that. That is before the Fed meeting. The Fed likely already has that information. After that, there's really no economic data for the week. So really this week, the Fed is the primary game in town on Wednesday. Let's talk about scoring. I went back and forth of giving this market a +1 or a +2. Now, one of the things I hate, and you're going to see that this has happened a lot over the past couple of weeks. The past 2 months. We've gone from like +1 to a 0 to a -1 to a -2 to a -1 to a 0 to a +1 to a +2 to then a 0 then to a -1 last week. This is what happens when you get this flat price action. So I always like to be a little bit less, I don't want to say generous, but on my scoring, I really want to try to stay around +1, 0, and -1 because I don't want to get too far out. If there's not a clear trend, I don't want to get too far out over my skis. So I was looking at this, I'm saying, hey, you know what? Just on Thursday, if I scored this on Thursday, I would have been at a +1. Now it's a +2. If you wanted to score this a +1, go ahead. Go right ahead. Go right ahead. It doesn't matter. We could absolutely fail to break out here. And then again, the less bullish you are, the better it's going to be. If we do break out here, then you do want to be more bullish. So I agonized over this. I said, you know what? I'm going to go with the +2. I'm going to go with the +2. I'm going to get a little bit more bullish in this run up to resistance. If it fails, yes, it will sting a little bit, but that is our life as traders, taking educated guesses with no assurance of profit whatsoever. Let's go ahead and break down the sectors because the market has been a little iffy, going through, +1, 0, -1. Sectors have been rock solid. If you've just been trading off of sectors alone, you've been doing fantastic.
Many people are unfamiliar with exactly what proprietary trading is. Prop trading is when a private firm hires traders like you to trade with their capital. Those traders are paid a percentage of the profits that they generate for the firm. Profitable traders are awarded higher and higher levels of capital to trade so they can take bigger positions and make more money. We've been in business for over 25 years and we're one of the oldest prop firms based in the USA. If you would like to look into being a trader for Maverick, look in the video description below and click on the trader position to apply.
Right, let's take a look at this performance here. My favorite sectors lately have been utilities, real estate, healthcare, industrials, and financials. Those have been my 5 favorite ones. And they were going up all of August and all of September. They are continuing to work. So utilities, real estate continue to just crank higher. These are the ones I've been overweight in my trades. I've been underweight in things like technology, consumer, materials, and energy. This is where I've been more underweight. Now look, you can see that tech and consumer had the largest bounces this week, and they absolutely did. But for the most part, everything has been about 3%. I do want to point out 2 sectors. Financials. This was one of my 5 favorites. It did really well in August. It got crushed last week, and it did not bounce back. So I absolutely have to downgrade financials from my list. And energy has been on the bottom of my list, and it got even worse. So energy is definitely the worst sector at the moment here. So the big question is, how much does this big bounce in consumer technology, does that make them the best sectors? Or am I still better off hanging out in the strong sectors over the last couple weeks? Here is the utility sector, and this is what I'm talking about. I've been playing in this sector all month long, and it's been very good to me. Whether market's going up or down, it's just been paying off. It's a +3, closing at new highs. Here we have comm services. This is one that has been flip-flopping between +1, -1, maybe even a +2, -2 at times. Take a look at where it is. Okay, it's now slightly bullish, just like we were back here. Okay, back here we were slightly bullish. Even here we were slightly bullish. This is not a sector you want to get wildly bullish on. Utilities is a sector you want to be wildly bullish on. This is just a +1, just a +1. So here we have real estate. Real estate is a sector I've also been wildly bullish on. And you can see all it's doing is running up, basing, running up, basing. Here we are, new highs. It's a clear +3. Stick with the strength until it proves to you that it's no longer going up. Now, healthcare was one that I was also +3. Back here, it was just looking fantastic, +3. We did have a bigger pullback than the other sectors. Okay, you know what? You can definitely look at these candles and say, boy, I wish there would have been a better bounce this week. I agree. I wish there would have been a better bounce this week. I'm going to give this a +2. It's a +2. It's not the strongest sectors out there, but it's still doing okay. Coming over to industrials. Industrials had a big pullback. Big pullback, but take a look at the bounce. This bounce looks much better than the bounce we saw in healthcare. We're going to give this one a +2 as well. And then financials. This is what we're talking about. Financials just did not have that great of a week. Take a look at this. These are not great bounces compared to what we saw elsewhere. We got to downgrade this one to just a +1. Coming over here to consumer discretionary. It looked really bad a while ago. It ran up and just parked itself right here for a while. This base, a breakout of this base, it's telling you, okay, this thing paid its dues. It had a bad July, came up, it based in August, and now it's ready to run, putting this at a +2, maybe going to a +3 next week. All right, let's take a look at tech. Tech has been super volatile lately. Again, -2, +1, -2. Here we are. We're simply back to a 0. I can totally understand if someone says, hey, Rob, I just want to be around +1, 0, -1 on technology until a clear breakout. Perfect. Absolutely perfect with me. This is one I don't think you want to get overweight on it yet. Here is the materials sector. Had a big pullback as well. This is a nasty, nasty pullback. But you can see the bounce was pretty nice here compared to financials. This bounce is telling you that buyers are coming back in it. We're going to go to +2 on this one. And then energy. It tried to bounce at the end of the week. This is just a really pathetic candle. A really pathetic candle on Friday off of a bottom. You know what? It was a -2. I'm going to move this to a -3. So if we take a look, this is where we were. What got stronger? Utilities, real estate got stronger. Healthcare's industrial got stronger. Financials went down to a +1. We got big upgrades. They all jumped 2 spots. Tech, comm services, consumer materials, and then energy down to a -3. Now look, I don't think you want to be like full on, the sky is falling in energy. Oil's had a big fall. It's probably bottomed out here. I think you just want to be mildly bearish in energy. It's a -3, but I really like -1, -2 trades better in that sector. Let's take a look at the trades we have made and the ones that have fallen off. So last week we put on 4 trades in, and mostly just slightly bears. Slight bear consumer, slight bear in materials and energy, and a little bit more aggressive bear in tech. What rolled off? Neutral in energy, a neutral in financial, and a +3 in the healthcare industry. So if we take a look at where we are at a +2, and we take a look and see, okay, what do we have on right here, right now? These are the trades we can allocate. These are the slots available. If we take a look at where we are, we got to get back on the bullish side. We were leaning a little bit bearish last week, which is exactly what the market told us to do on the technicals. We're now saying, okay, you should now be slightly bullish, so let's add in some bulls. Hopefully everyone can see we're still in the middle here. Look, I am bullish. I am very bullish at the moment. I'm not like super bull, but again, I'm bullish. I can feel bullish. I can talk bullish. I can be bullish. But when I take a look at my portfolio, I'm going to just make it lean bullish. Look, if I miss a move, a big move, I'm only going to make a little money, not a lot of money. Guess what? During the whole space of a year, I'm not going to get them all right. Some of them I'm going to get a little bit right, and some of them I'm going to nail. That's how we're going to win this game. So I'm putting on a +1 in comp services, +2 in industrials, +2 in consumer, and then a neutral in the financials. Again, I'm not loading up on the financials here because I think this market is it's too volatile to really hit a good butterfly, I think you want to wait for it to calm down a little bit. So let's go in and look at some of those potential trades. First off, in comm services, we've got Cinemark. As a young trader, I could have never traded this stock. These stocks were so hard for me because they never pulled back. They never did anything. They just kept creeping higher every single day, like a couple pennies at a time. You know, I wanted these big dramatic moves and these big dramatic pullbacks to buy into. And so I waited patiently, and they just ran away from me. They just went away from me. So now I've learned, okay, this is a bullish trade. It is just so bullish, but it's not a rocket ship. You know, back here it was a rocket ship, but right now it's just creeping higher. These were very difficult for me to trade until I learned the diagonal call spread strategy. I love diagonal call spreads for this reason. It gave me the perfect strategy to get into these. So if I go out and I do the October 27th, September 20th, 29 diagonal call spread, I'm playing it from here to here, and it is a sideways trade. If this trade goes sideways, I make money. If it goes up, I make money. It just can't crash. That's it. It just can't crash. And if it doesn't crash, I make money on it. I really love these trades. It is totally a slow and steady wins the race kind of trade. If you do want to be a little bit more aggressive, then you've got to go all the way out to October 18th. Do the 28.30 bull call spread, or maybe even the 28.31 bull call spread. I think that's stretching a little bit too far, but again, these stocks just continue to creep higher. Next up in industrials, where we also want to be a +2. Here's another one. Would have been very difficult for me to play this when I was a young trader because I would look at it and I'd say, oh my gosh, this thing was $100 a month ago. And now it's at $133? No way, I missed it. I'm going to go find something that hasn't run yet. Well, we all know, we've all had that mentality and know that it doesn't lead to gains. You want to buy the things that are outperforming. It's run up, it's pulled back. Here we've got a nice run here. Short-term 135 is going to be some resistance. But after that, if the markets break out to new high, I don't see any reason why this doesn't break out to a new high. If you want to be less bullish, diagonal call spread. Again, it's right at 133, so you do the 130, 135 diagonal call spread. Again, as long as it doesn't go down a lot, that's just a money trade. Again, you're not going to make a lot of money, but it's going to be solidly profitable. If you want to be a little bit more bullish, do something like a 133, 135 bull call spread out 2 weeks. You're just asking it to go up to prior resistance. If we were in a better market, if we were in a +3 market, I would be much more aggressive on this one. I really like this trade setup, but the fact that we're not, I'm going to temper my my targets a little bit. If we break out and run higher, the next trades I take will likely to be more aggressive. In the financials, doing a zero trade, I do have to fill a zero slot here. So I really looked around to try to find, okay, what is just dead? What is just not moving and just totally stuck? And came across Capital One. As you can see here, ultimately, we've got maybe up to 130 to 150. But more recently, we've got 135 to 145. That's going to be the trade. 2 weeks long, 135, 140, 145 butterfly right in the center. Now look, if someone says, hey, I think it's going to be at 142 on September 27th, great. adjust your butterfly to that midpoint. But I'm just going to go pretty much straight butterfly, maybe bullish a tiny bit. $1 on $139 stock, that is not very bullish. 140 is going to be my target on this one in Capital One. And in consumer, D.R. Horton. This is a home builder stock looking really good. All the home builder stocks are absolutely on fire here. Had this little bit of a pullback, base, whatever you want to call it, but you can see Friday's price action is clearly breaking out to new highs. I'm going to look up to 200. I think 200 is a very easy target for this. We're asking for this thing to go $5. It's a $200 stock. That's like 2.5%. Very, very reasonable. Bull call spreads, if you want to do something tighter, 195, 197.50. If you want to go a little bit more aggressive, up to 200. But again, this is not that aggressive. We want to wait until we get that +3 in the market before we really stretch out and go aggressive on any bulls here. Remember, look, we were right at all-time highs 2 weeks ago, and I said the same thing, and we didn't have any follow-through, and actually sold off pretty hard that first week. It's the same thing. We have no idea what's going to happen. We're playing the odds, and we have to realize there is resistance there, and if it breaks through, then we can get more aggressive. But until then, I think you want to be just leaning to the bullish side. Wrapping this up, FOMC meeting on Wednesday. As always, expect volatility. We've seen where one day it comes out up 3%, the next day it's down 3%, and it just basically did nothing. Expect volatility around those reports. That's pretty much it. I want to really shut the door on this September 1st to October 15th. Look, for the last 3 years, we were pounding the table on this, and we were totally right. Totally right on they were bad 6 weeks. I want to just stop talking about it, because if we have a strong week and we break out to new highs, I think you can pretty much shut the door on the bearish seasonality for 2024. It's going to be one of those years where it just didn't happen. So hopefully we don't have to talk about it again after this week. Everyone have a great weekend. Stay safe. Bye.